This is Darius from QCP Capital. I'm here today with Kyle from Three Arrows and Kevin from Galoa, and we are here to talk about crypto trading and specifically crypto derivatives. I've known these guys for a long time. I've known Kyle since before crypto days, and Kevin since a couple of years ago when I first started in the space. But yeah, maybe I'll let Kyle and Kevin do a quick intro as well.
Yeah, appreciate it. Actually, Darius I've known since we were trading FX together. He was at the largest FX macro hedge fund in Singapore. And we were trading a bunch of FX as well. But it's interesting how the paths kind of changed over time. And now we both trade almost exclusively crypto. So that's kind of interesting.
Yeah. So I'm Kevin. I know these two from a while ago. I actually knew Darius first when he was starting up the OTC desk at QCP, and we've definitely done quite a few trades together. Always been a great counterparty to have. And then Kyle at Three Arrows. I think we met a while ago when you guys were. Still, I think, right before, I think, you guys did the whole Deribit round, and which I'm an investor in. So, really good to see all of you guys. I think we've all been in space for quite some time now, and love to get your guys' thoughts on, just trading in general. And I guess derivatives is the big new topic in mind.
Yeah, I think the interesting thing here is that, I think even though, three of us are all in the crypto trading space, and it's not that big a circle, and there definitely overlaps between the three of our three firms. But at the same time, we have very, very different approaches to the space as well. So maybe that's a good way to kick off.
Sure.
Yeah. Why don't you go ahead, Kevin? Why don't you start?
Sure. So, I think one thing that we do that's pretty distinct is that we're purely a quant firm. So, mostly, math, physics, stats guys. And, we try and approach the market in as systematic a way as possible. And what I mean by that is, I think there's generally different kinds of these quant firms. Some are pure black box and some are more gray box. I guess the ones where you see, traditionally having, 6, 7, 9 screens, they're manually adjusting the parameters in real time to their trading algos. That would be more on the gray box side. I think for us, much fewer screens, we're much more black box, we're writing just a bunch of code and we're never really changing the parameters up in real time. If there's some way to codify the logic of what we have in mind, we try and do it directly in the code without, manual intervention. So, that's sort of our approach. And I think, I think within the space, you have different firms taking after different traditional finance prop shops and hedge funds. I would say the gray box approach is more like, SIG or Jane Street. And I think, our style is more similar to Jump or Tower. So, I think that's I think something fairly distinct about our way of trading.
Definitely. I can build on that too. I mean, Kevin's bringing up a good point that prop is a spectrum. And the spectrum is from, let's say, ultra low latency, putting in the best tech, really just trying to make the microseconds, all the way down to broking. I would say that's the spectrum. And broking would be guys on a chat making a bid and an ask price. And then there's a whole spectrum in between as well. So for us, I would put us somewhere in the middle. Maybe Kevin's a little bit more on the automated side. Maybe we're somewhere a little bit towards the middle, where we're very involved in the borrow market, for example. Borrow is very much an OTC market. You're on chat, negotiating deals. And then on the trading side, we try to automate as much as we can. So we try to be algorithmic there, but we're not the fastest shop. We're not the lowest latency. We're not market makers for most spot or derivative markets. So there's something for everyone, and basically everyone has their own alpha. It could be the tech, it could be the people, it could be the OTC access, but prop is a large spectrum.
Exactly, and I think Kevin's on one end, Kyle's in the middle. We are probably on the other end of the spectrum. We focus a lot on local markets, so we're very active in Korea, Thailand, Indonesia, Malaysia, and we're trading crypto in local currency. So we take a lot of local currency risk as well, and besides that, we are also extremely low latency, almost pretty much manual in terms of more structural trades on options, option strategies. Yeah. So I think pretty good, nice. Every part of the spectrum is represented in this conversation.
Yeah, I definitely think that way too. And I think it's important to identify it this way, because if you think about other investing, so let's say early stage venture capital, I don't know if there's as much of a spectrum. It's much more of a region focus or a product focus, something on that order. But it's not necessarily a spectrum of tech to broking. And prop in general is shrouded in a lot of secrecy, right? Because you generally don't have a lot of investors. So you're not openly advertising what you're doing, except if you are trading with OTC counterparties. And then you absolutely do have to, because you need to build a relationship, right? But yeah, I think that I like the idea of the spectrum, and we all fit in different parts, which is kind of nice. And also in slightly different areas.
Yeah, and just jumping on that, Kyle, maybe you could clarify a little bit on your side. Are you guys actually running prop right now? Because I know that for ourselves and Darius, we do take outside capital, and we do have investors. But for you guys, are you guys running prop, or do you guys have outside investors?
So I set up the firm 8 years ago, and all my bosses set up hedge funds, pretty much, that left. The smartest guys did. That was the thing to do at a bank. And so I did the same thing. And I set up a master feeder hedge fund, regulated in Singapore. And we still have that structure. But we just, over time, realized that it didn't quite make sense to have lots of outside capital for the strategies we were running. So we actually don't run outside capital right now. We've thought about it, the ways we could do that. I think I actually made a post yesterday that got a little bit of traction on Twitter, where people talked about the difference between a borrow market and a high fee market. A lot of firms think about this differently. So some firms, they decide to charge very high fees. Like normal hedge fund fees are 2% management. That's 2% of the assets charged per annum, plus 20% performance over some hurdle. So like you make 50% return on capital, then you have to pay 10% as a fee to the manager, right? 2 and 20. That's the normal hedge fund fee. If it's capacity constrained, a lot of people will charge much higher fees. They'll say, okay, we're going to do that model, but we only can take 20 million of capital total. Thus, we can charge 4 and 40 or whatever they can get away with, right? And for them, the math is always that versus borrow. Like, what is your borrow cost and what is your fee? There are some nuances here in terms of investor protections and upside versus downside scenarios, but generally speaking, that's kind of what people's math looks like. And so when we did that math, we just, we came up with our solution.
The returns are that high, huh? You don't want to share it with the investors.
We did when we first started. We did when we first started, and we returned capital pretty quickly. Yeah, I mean, the dream in prop is to run your own capital someday, right? And Definitely. To get to that point, there's always something more you can do, right? To get to that point, sometimes you have to take investor money on a 2 and 20. Sometimes you can charge higher fees. Sometimes you can do it as a borrow. It's kind of a mix. And you actually have some very interesting share classes in your fund that I think are quite innovative for hedge funds. And I think you've done a particular angle on that one.
Yeah, definitely. And I completely agree with you that I think it all comes down to the opportunity cost of capital. If it's cheaper to get borrows, then, why take on more investor capital? Investor capital could be really expensive. Maybe they're taking 80% of the upside, 70% of the upside. So if the borrow is like 10% annualized, I mean, if your returns are good enough, it never makes sense to take on more capital. It's always better to take a borrow. So completely agree.
Yeah. Depends on your Sharpe ratio, how much you're making, what your downsides are, how much you have versus investors. There's a bunch of math that goes into it, but at the end of the day, it's just incentives and and a negotiation with investors.
Definitely. And how about yourself, Darius? How do you think about capital allocation and just figuring out where to source it from, opportunity cost, that sort of thing?
Yeah, just to clarify, we actually don't have outside capital. It's pure prop as well. Yeah, but no, I completely agree. And the reason for this, I mean, just to sort of segue into this topic, right? The reason for this is that you're right? Investor capital is actually the most expensive form of fundraising from our perspective. If it's 80-20, you're giving away 80% of the profit. Is insane. and you know, something to touch on what Kyle mentioned as well, that with crypto, the biggest concern was actually not cost of capital. The biggest concern was capacity constraints. You know,
Yes.
in hedge funds, you know, it's part of the hedge fund game is always an AUM game, right? You manage $4 billion, $5 billion. Even if you don't make money, the hedge fund manager still gets rich. So you know, you can't do that in crypto at all. You know, in crypto, you if you have $1 billion, you have no idea where to put it. With that said, you know, the landscape 2-3 years ago and now, in terms of capacity constraints, I think it's vastly different. I think the growth has been exponential, whether it be options, perps, futures, even DeFi, right? I mean, you know, the capacity has grown a lot, and I think, you know, I think we're going to start to see exponential growth in terms of capital allocated into the space. You know, especially, I think, you know, this year especially, we saw news that Renaissance was thinking about deploying. Paul Tudor Jones was thinking about deploying, and you know, with that, there's been a very huge jump in interest from the traditional market guys. Seen a couple of banks starting to step in as well. And the interesting thing to me is that these banks, you know, the banks that we've spoken to who want to step into the space, are not taking the usual path of like, do the Delta One spot products or what. They're going straight into options and straight to exotics and that kind of thing, right? So, you know, I think, you know, some interesting stuff happening this year for sure.
Mm-hmm. And how much capacity do you think there is right now for like the strategies that you're running right now? You know, if you had unlimited access to capital, at what point would you say, okay, we're full, that's too much, you know, there's nowhere to deploy it anymore?
I think the number in my head, you know, I mean, let's say just for us as an individual firm, the number in my head, I would probably put it, and you know, I think 100 million the market can take no problem. Probably about 250 to 300, you know, then we start feeling strained and you start having to diversify into different kinds of products. But I think, let's say specifically for options, you know, I think $100, I think the market can stomach that. You know, you know, I think Kyle can answer this as well, and he's in the boring lending side. I think that probably has been the most scaled up section of the crypto space in terms of products that are similar to traditional markets. I think that space has grown a lot, and the sizes are very institutional. I'll probably let Kyle take a bit more on that.
Yeah, well, one thing I would fill in this is I mean, we run firms, right, that have like multiple people in them and have scale to, you said, deploy even 100 million. To a lot of people, 100 million sounds like a lot of money, right, to manage a firm. But you have to remember, if you're starting your firm with smaller, like let's say 1, 5, 10, you have to believe you're going to get to 250, 300, or like a really high number to accumulate assets. Because even at 2 and 20 on, like if you raise 50 million is not, like if you're a VC, it's fine because VCs can launch multiple funds. In fact, they can, you know, and they can lock it in for a long amount of time. But for a hedge fund, you have 2 bad months, you lose your capital, right, very quickly. So yeah, I think that those numbers are approximately similar for almost every one strategy, for any prop strategy in crypto. And I would say if Bitcoin were 50K, then maybe we could all try to raise more money. That would help.
That sounds good.
But it is nice to see, and I certainly agree with your other point that we're seeing a lot of market entrants, and I think we're going to see a lot more very soon. Sophisticated banks, and I think people in crypto tend to underestimate the sophistication of new investors into the space. And sometimes it's easy to forget that, you know, you may be crypto native, you may have been around since 2012 or whatever, but like some other guy might have been trading, you know, exotic equity options for like 20 years. I mean, he's a pretty sophisticated guy. And if he decides to go into crypto, and he's going to be very comfortable with accumulators, knock-in, knockouts, like products that maybe a crypto native person is not quite familiar with. Like they have the tools to build it, especially in DeFi or on-chain, whatever, but they may not have the 20-year experience of seeing what that product looks like in the real space. And I think that's the exciting part. When you bring in new people, they're not noobs. It's not always a noob or a pleb that joins. It's sometimes very sophisticated managers. And I agree, we're going to see more of that.
Yeah, I completely agree with that, Kyle. I think, you know, the real competition is yet to really come. You know, you look at all these prop shops out of Chicago, there's plenty of smart people in the world. You know, it's just, you know, one of the reasons they haven't come full force into crypto yet is just because the market isn't big enough for them, right? But when they do come full force, I mean, with the infrastructure that they've built out, with the experience that they've had over the decades, you know, certainly that's not going to be easy. And I think the game only gets harder over time. You know, hopefully, you know, also we're getting better over time too, and we'll be able to compete. And, you know, same for you guys. But I think, you know, I definitely agree. I think there's a lot of competition sort of looming on the horizon that I think a lot of crypto people discount. And I don't think that, like you said, that these guys are newts. I think these guys are quite good at what they do. But I wanted to touch on another point, a really interesting point that you brought up, Kyle, which is that you said that basically for VCs, they get to lock up this capital for a really long period of time, right? And, you know, they could raise multiple funds, this, and that. While, you know, for a fund or like a prop shop, you know, we live and die by every month, right? So in your opinion, are you suggesting that, do you think it's harder or easier to be a VC versus running a trading firm?
I think they're different. I think they're different. I think it's an unfair question. I think the point I was trying to make is if you raise a $100 million hedge fund in traditional space, on average, you're losing money. The average hedge fund is break even on management fee at $250 million AUM, $250 million. So if you raise $100 million, given the fee breaks you're going to have to get and the deals you're going to have to cut for equity, on average, you're losing money. Well, in crypto, how many hedge funds can you name over 250 million? Like very, very few, right? I think I can name them on one hand. But a VC is very different. In the real world, or the non-crypto world, if you raise a VC with $20 million, that is totally fine because that capital is locked up for, on average, let's say, I don't know, 5 to 10 years. And you can raise every 3 years or so, you can raise a subsequent fund if you want. So on your total AUM over a 10-year horizon, you could be running, let's say, $80 million of hard capital that's fixed there, right? And you can really gun for the fences. If you, if you put in some really big bets and they go sour, your capital's still locked up, right? So yeah, I would say a $20 million VC locked up for 10 years is probably more lucrative in the long run than a $100 million hedge fund that has monthly redemptions. So maybe that's one way to phrase it. But that's not to say one's better or one's worse. Like totally different skill sets. You know, so unlikely one person can do both.
You know, guys, I think when I'm a bit older and, you know, just a little bit more world weary and just tired of the daily hustle, I think I'll just be a VC. You know, I think it seems like a nicer life. You know, you can be wrong for a very long time and still look really smart. You know what I mean? what do you think, Darius? Do you think it's harder running a trading firm or being a VC? What do you think there?
Well, I mean, I've always been on the macro side, right? You know, the VC side has always, I mean, I always have this conversation with my partner Josh, right? I have no idea how this VC thing works, right? You know, I to me, to this day, I mean, we've done some VC deals as well, and it's still very, very alien to me. You know, I still think the macro side makes a lot more, the market's a lot more efficient, right? The market's a lot more efficient. It's easier to understand. I still don't know how you justify some of the valuations that you have in VC. So, you know, I sort of agree with you on that part. You know, you can get away with things for quite a lot longer than you do.
But I think I can tie this together real quick. So anyone with $1 million can try to start a hedge fund, try to start a high frequency trading firm, or try to start a prop trading or a VC, or try to get into property development. They can try to do many of these things because the capital costs are by definition not that high, right? Like you would never try to found a car company, or you would never try to design a new iPhone, or you know, things that are even cheaper. You can try to be a novelist. You can go try to write a epic poem if you want. That'll cost you $20,000 a year. You just have to pay for your expenses. But the reality is, all these things, the alpha is not the capital. Like there is a capital component, but the alpha is not the capital. Like the alpha in prop is, you know, your market knowledge, your tech, or something, right? The alpha for VC might be deal flow, or other things, right? So I think that looking at the capital component of a business is like looking at their working capital. Like you wouldn't look at the working capital of you know, a restaurant and then say, hey, I can also run a restaurant. You'd say, well, wait a second, who's the chef? like, what are we making here? Like,
Yeah.
Yeah, definitely.
Exactly. Yeah.
Definitely.
Cool. Well,
No,
I got one follow on for Kevin. So you mentioned all these market entrants, and you mentioned them as potentially competitors. And I'm thinking of them, yes, they could be, but I'm thinking they can also be partners and they extend the space, right? And one way I'm thinking about that is right now, for exchanges, for example, most exchanges are run in AWS cloud. It was designed that way because in crypto, it's exchanges like everyone to connect from everywhere in the world all at the same time. That's not so good for a lot of things like throughput, latency, other things. So for example, Deribit, metal exchange, high volume, high throughput. It'd be hard to have tons of retail all connecting at the same time, but it's wonderful if you want to have really good pricing, best execution, high volume. Are there any other, so this is a clear trend for me anyways, like we're going to see much more co-located metal exchanges, which is really important. What other things do you think are going to happen?
Yeah, I definitely agree with the colo part. I think Deribit already has colo, right, at LD4, and you can do a cross connect with them. And I think, you know, maybe the way the space evolves is much like, you know, I hate to say it, but maybe just like exactly like traditional finance, where there's going to be like these brokerages that handle all the retail flow, and then it's just really the brokerages who have seats with the exchange, who then directly connect with the exchange, right, on the same rack, in the same data center. That seems to be a lot more scalable than having, you know, these millions of retail connections all over like AWS, everything, you know, going through Cloudflare. So there's another extra jump. You know, it's just the whole thing doesn't seem too efficient. And I think, you know, maybe the reason that this hub and spoke model evolved in traditional finance is exactly because of this reason. And maybe we don't need to reinvent the wheel. But you know, could be wrong. It's really hard to say. You know, I think, you know, in comparing the crypto markets with traditional markets, you know, sometimes, you know, it looks like equities, sometimes it looks like Forex. I mean, you can definitely compare, contrast, you know, a lot of like details. Like, for example, you know, I think with Forex, for example, there's a lot of fragmentation of liquidity, which we also see in crypto. It operates 24/7, so it's a lot like crypto. And I think for the most part, there's not much central clearing. I think only like 25% of trades are centrally cleared, I think, in the Forex market. You know, don't quote me on that, but that's from what I remember. So, you know, I think it's possible that crypto goes that route, or it's possible that, you know, crypto has a lot of these characteristics of Forex, but also, you know, ends up, you know, having, you know, some kind of giant, you know, OCC or some kind of like clearinghouse that everybody goes through, right? So it's not clear, you know, exactly what way crypto is going to go, and that's why, you know, I kind of think of it as a completely different asset class. That was a little bit of a tangent, but, you know, just a random thought there. Yeah.
Yeah,
No,
the
yes,
only thing
exactly
that's
right
clear to
on
me
the-
is it's going. It's going. It's like, it's not going to remain in an AWS cloud. I don't know what it's going to end up, but it's definitely going somewhere.
I think
And what do you think about it?
Part, on the
sorry,
Forex part, you're right. You know, I mean, crypto is similar to Forex in a lot of ways, but let's say you look at crypto options specifically, it's not going in the way of Forex. If you look at FX options, there's 99% OTC, completely fragmented, prime brokerage. There's, you know, it's all bilaterally traded. Whereas crypto, you already have that centralized on certain exchanges. You know, so that part's really distinctly different. So, you know, you're right about that. It's going to be a completely different animal, sort of mix of both.
Mm-hmm. And how much room do you think there is for, let's say, multiple options exchanges in crypto? You know, Deribit right now, being the market leader, extremely dominant in open interest and volumes. Do you guys see that changing over time? You think there's enough for, you know, 2 or 3 players, or you think it's just going to be, you know, pretty much winner take all? Just, you know, in my opinion, you know, I think maybe just to share that a little bit, I think there's probably room for a few, but I think it's going to be fewer than the spot exchanges, just because the way to replicate liquidity on an options book, you know, there's so many different dimensions, calls, puts, different terms, different strikes. It makes it a lot harder to defeat the network effects of the incumbent. But, you know, I don't know, maybe I could be wrong. What do you guys think about that?
I think of it as a funnel, actually. I think of it as a funnel where liquidity is tranched. So if you open up a Deribit screen right now as a retail person that's never traded an option before, it's going to be a really uphill battle for you to figure out how to trade options. But if you were to open up Binance's platform, they have options. It's a mobile app. You can't trade it on the screen. It's a mobile app only, and you can only buy. But maybe if you're a retail guy, that was easy for you because you already had a Binance account and you only wanted to buy anyways. Who knows? And so that's a new user. And there's a couple other examples I can give too. But basically, liquidity could be tranched because different exchanges could go after different kinds of clients. But at the end of the day, if you want to trade high volume, low latency, all cross margin to one account, because if you trade a call with a client on one strike, you might hedge with a different, and then you might delta hedge that too, and you need all that collateral in one pool with the best liquidity. I think that should be one place. That is the most efficient way to do it. If it were two, I don't know, maybe there's like a one that's better suited for one time zone, one for another, but it would be more efficient to have that as one. And I see it more as a funnel.
And I think, just to add to what Kyle said, the current situation is exactly that. If you trade on CME, the risk is getting cleared on Deribit. If you trade on OKX, that risk is exactly being one for one being cleared on Deribit. So the funnel is the case right now. But I would say, in terms of the coin settled, unregulated exchange, Deribit will retain dominance there 100% for sure. I would say in that little tranche funnel, right? So Binance might launch their options product, or various other exchanges might launch the option product, and that will funnel to Deribit. What I think is a critical tranche would be the regulated exchange, right? CME has started to take up a lot of volume, and I think that trend will continue as well. It will still come to Deribit, but there will always be a whole tranche of people who can trade on CME but cannot trade on Deribit. So I to answer your question directly, if you're saying 2 or 3, I would say maybe Deribit plus CME plus maybe one more. But with that said, Deribit is still very, very dominant in terms of what we are seeing, where the flows are going to.
Yeah, Darius, I think you bring up a great point that, really all of this other options volume across all these other options venues outside of Deribit, a lot of that is being crossed on Deribit, right? So like how much organic volume do you think there is outside of Deribit, right? I mean, there is a whole bunch of other volume, but how much of it is actually organic versus how much of it is just people, de facto or literally cloning over liquidity from Deribit? What do you think the actual market share is right now of Deribit?
So I would say I would use our own flow as an example, right? On our book, I would say 25% is crossed off Deribit either internally or with on other venues, but Deribit easily takes up 75% of the volume. So I mean, using our own flow as a sort of guide to the industry, I would say 75 to 85%, easy.
Hey, Darius, a bunch of people have been for a long time talking about an OTC clear. There were numerous firms that tried, couldn't get either the credit, so they didn't raise enough money for people to want to face them, or couldn't get the cross-margin capability or the master clearing agreements, whatever it is. Do you think we'll see one of those someday? How close are we?
I mean, as you know, I was also intimately involved in some of these, right? And I thought, 2 years ago, I thought, I was very confident that crypto is going the way of FX. It's going to be central clearing, it's going to be standardized rules, ISDA for everybody. But 2 years later, looking back at it, it has not worked out. I think the space is to some extent not ready for it, and not ready for it not because they don't want it, but because it's actually quite easy to cross on Deribit. So there is almost a case of there's no need for it, right? We were looking at we've been talking to some counterparties for many years, and we were trying to get ISDA going through, and these kind of standardized things going through. In the end, we just looked at each other and say, why don't we just cross the Deribit, and then that's the easy solution. So there's almost no need for it. So I think to answer your question, there are still guys who are trying to put these things through, but I think to some extent it's not necessary.
So in FX has that, but it's very top down. Like the banks own the central clear, and they forced all of it to go there, and they probably burned a lot of money to get it to go there to start with, anyways, right? So I guess the question would be like, crypto generally is bottom up. Like FX is very much top down. Banks control everything; they own the top clears, and then the liquidity is tranched downwards, right? Customers can participate in that market as the banks see fit, as they've defined it, right? Whereas crypto is the opposite, right? Crypto, someone wants a new option, they go to you, like you'll probably quote them, right? You'll probably make them a price, and you don't force them to clear in a certain way. You just trade in the most efficient way. It's more organic, I would say. So yeah, I don't know. Like I also thought someone would just pony up and say $50 million in this central clear. I'm paying everyone to join it. Everyone has to clear here now. And in the end, maybe that would work out. But in the interim, that would be a serious money burn, right? And given the excesses of 2017, I actually thought someone would do that because there was so much more money that was burned doing other useless things, right? But maybe now people are much more rational, and so it's harder to get that. And the oligopoly is spread too thin. So maybe
I mean, a simple case of if one of these guys comes to you and says, "Hey, why don't you pay $100,000 for a seat on my clearing on my as to be a clearer or whatnot," right? You're gonna ask him to buzz off, man, because it's just we're just not used to paying the kind of fees, right? The banks pay for their seat.
You know another major difference in FX is prime brokerage. So you have the central liquidity, which is governed by if corporates trade with banks because they have a banking relationship, and all that funnels down, right? But you also have prime brokerage, which is like a whole nother stranglehold that banks have. So when you were trading FX, you had an FX prime brokerage account, right? And that was the only way that you could clear. And if your FX prime broker said, "Hey, we don't support this venue," or "We want you to clear on this venue," or "We make it cheaper for you to trade," then you would trade on that venue. So it's kind of like forced in a lot of ways. Citibank, for example, has been for a long time a huge percent of the prime brokerage business for every major FX trading fund. You had an account there, we had an account there, everyone did, right? You had to.
Yeah.
And they recently just came out and didn't support some venues, right? Some ECNs, which are clearing because maybe they weren't as friendly to Citi or whatever, right? You can't do that though in crypto. That doesn't fly. You don't have that stranglehold of prime brokerage and that stranglehold of the corporate flow. So you can't govern it, and you don't have 50 million to blow on a project for the next 5 years to see if it works. But basically, I don't know. I think crypto is all bottom up. FX is all top down, and so I agree. It's not going to pan out the same way.
But in that way, actually, I think this is one specific area where the ideals of I won't say decentralization, but democratized finance has come true, right? Back in the day when you wanted to set up 3 arrows, you have a whole laundry list of prime broker, custodian, and they all cost a bomb. I mean, today if you want to set up a $50 million hedge fund in crypto, you just set up a few accounts and you're good. So I think there is definitely some very strong democratization in terms of the way serious capital is managed in the space. And for that reason, I think there would be more inflows very easily and very quickly as well.
Yeah, and I just wanted to add one other comment about the whole clearinghouse situation in crypto. All these guys making these plays. The answer is always the same, which is that I'll join your network once everybody else is on. And it's just like this kind of chicken egg problem. Nobody wants to be the guinea pig. Nobody wants to pay 100 grand, get a seat for who knows how this thing will play out, right? It's a lot safer for me to just watch everybody else get on the network, and then it has some value. So yeah, I mean, I think unless they're willing to put down the very heavy fixed cost to get it going, there's no marginal cost. There's no marginal benefit for any individual to join before anybody else does. So I think there's a very serious chicken egg problem there. Yeah.
And there are other network effects that are probably more important and more organic. So for example, moving funds around in a secure way. Fireblocks has pretty much nailed that market at this point, right?
Definitely.
And that is a true network that is truly scalable. And there's a couple other examples I can give too, but basically there are networks which can organically grow. It doesn't have to be no one wants to join until there is one. It provides immediate benefit and then more benefit and incremental benefit, and then it just becomes the de facto network that everyone uses.
Mm-hmm.
So let's see. Second derivative options. Darius, when are we going to get those? Everyone's been talking about these, especially in Asia. Asia is a huge exotic derivative market. In the US, a lot of these are not standard products for the everyday person, accumulators, knock-in, knockouts, trigger redeemables. But to everyone in Asia, this is a very well-trodden path. I mean, the average person in Korea, for example, will go to their local bank and maybe put $10,000 in a trigger redeemable, which will pay out a fixed coupon over time if certain things happen. Very, very normal product, very retail-oriented too. Why don't we see those in crypto? When will we? What's holding us back?
I think we are on the brink of it, right? Before this, is a question of who's willing to price, and whether there'll be a market for it. And to this day, if you ask me to price something like that, I would be a bit careful, right? When you have events like Black Thursday happening, these things can blow up in your face really, really badly as well. So, but I think we're on the brink of it because the private banking style of customer structuring is starting to happen, especially as these things get more regulated in Singapore and the rest of Asia, where in Thailand, Singapore, Indonesia, for example, and Korea that's coming up. The regulations are setting the way for these products to happen, because the regulators are stepping in, the finance ministry is stepping in and saying that these are okay, and then you have retail guys starting to look at these products, and then you have banks like Nomura and all starting to look at it as well. I think we're on the brink of it happening.
Mm-hmm. How do you guys feel about binary options? I think retail really likes to trade binary options, right?
Yeah, I mean, I'll let you answer that one, man.
Binary options in general have a very high edge to the market maker, so they can sometimes be a little bit toxic for retail, right? I mean, obviously, if it's a liquid market and you can have like a good tight two-way price, then it's less toxic. But generally speaking, like I think my thought process on this is there's two things that need to happen. One is you need the underlying liquidity to be strong, and the underlying liquidity for exotic options is vanilla options, so puts and calls, and that's Deribit. And if you look at their volumes and their liquidity, it's gone up huge the past year, especially in just not BTC but also ETH, soon to be others. So that unto itself will provide a foundation upon which people can build, right? So that's number one. But number two is what Darius was saying: distribution. You've got like all these banks coming in. They're sophisticated. They're not noobs. They're not plebs. They're sophisticated. They know all about exotic options, and they know how to pitch it and commercialize it in a way that it's hard for someone to organically start with. Like if I approach someone for an accumulator, it's going to be hard to convince that distribution channel like to go well. But if you're talking to Nomura or whatever, they can absolutely push that distribution channel because they already do for so many other products, and it's huge. It's a massive market, right? So if they can do that, distribution, and you have the underlying liquidity, I think that solves it. But yeah, we just haven't, like, we're at the beginning stage of it.
Yeah, and I think that one thing to add to that is that the yields in the crypto space, like just the implieds on Bitcoin and Ethereum, when you tell the traditional private bankers what kind of yields they have, this market is producing, it's becoming too hard to ignore for them, right? In the global market, you are seeing a negative interest rate environment, and it's harder and harder to generate yield. This is sort of like a little untapped island for them, and they're all going to come hungry very, very soon.
Mm-hmm. And just to touch on something that you said, Kyle, I found very interesting, and this is sort of more of a philosophical question for you guys. Kyle, you mentioned that with these binary options, the edge to the market maker is really big, and I agree that's the case. Now, for the most part, a lot of these retail guys, they want to speculate, they want to gamble. Should people be allowed to trade things that they want to trade? Or should they be protected from hurting themselves, giving up too much edge to these market makers? Like, what's sort of your philosophical view of the market there?
It's very philosophical. I agree. And my philosophical response to that would be: we in crypto self-govern ourselves. We do not have regulators. Largely, we do not have big risk departments that are telling us what to do or what not to do. We rely on ourselves. So if we see something that looks like a scam, then people regularly do on-chain analysis and call it out, right? Put it all all over online, and it's very much like a trust community-based system. So I would say the same thing goes with binary options. If we see someone ripping off customers massively, which is entirely possible for binary options, because it's hard for retail to understand how much edge is in a trade, then we, the community, should probably say, hey, you know, check out this other venue which has better pricing, or maybe you should design the contract in another way. But we should self-govern. That's the whole point of crypto. And I think that's the way I would think about it.
And I think through competition over time, you know, the edge will diminish. You know, there'll be more competition between market makers.
Yeah.
You know, that sort of thing. Yeah.
100% agree.
Yeah, I completely agree with you guys. Nothing to add to that.
Cool. Well, I think we're almost at our time limit here. But
oh yeah.
How do you want to close off?
How about we all just go around, maybe just give one trading tip that maybe we wish we knew when we first started trading. How about something like that?
Sounds great.
Specific to crypto, right? Specific to
crypto or in general, you know, however you guys want to do it.
Sure. I got one right now. I'll start. Your first trade should be to buy Bitcoin. It should be either to lend Tether or it should be to buy Bitcoin. Those should be when I say lend Tether, I mean lend dollars. Those should be one of your first two trades. And when you're lending, you should be lending it to a large intermediary, someone like BlockFi. If you are, and if you're buying, you should probably be buying on as the largest regulated exchange you can, something like Coinbase. You should be buying Bitcoin. You should not try to make 10x. You should not try to buy something small. You should not try to do an hour of research online and then put your money in a startup. You will get burned. You are new. You should recognize that. People have been in this for a while. If you don't follow this rule, you're going to end up buying the top of a pump or something else. You should either be lending dollars to BlockFi or buying Bitcoin on Coinbase. I think those should be the first two trades.
Darius?
Well, I think, you know, I would probably add to what Kyle said, right? The misconception that most investors have of crypto is that it's volatile. You know, it's very speculative. I would say the biggest opportunity in the crypto space right now is the yield space, right? Both the credit market lending, like Kyle said, as well as, you know, implied yield and options. That you know, as a new entrant to the space, you don't have to be taking directional risks. There are a lot of other lower hanging fruit that can make you good money without taking that much risk, and that should be something, you know, to explore.
Mm-hmm. Absolutely. And you know, I guess for mine, you know, I think one thing that that's really important with trading is to have a lot of, I think, emotional control. And I think a lot of people will get wrecked from being too greedy or too fearful. Well, maybe not too fearful, but you might not just make any money at all. So I think, you know, having very strong emotional control, trading the markets, you have a bad day, tomorrow's the next day, and not to let it affect you and not to go on tilt. And I think, you know, if you can manage that, you're already halfway there.
Sounds great.
Sounds good.
We really appreciate it. Good talk.
Thanks,
awesome, guys. Yeah, good seeing you guys.